Welcome to Quantitative Edge. This is what we are going to talk about today. Berkshire's liquidity hits all-time high. US versus EU profits, two opposing situations. We can now create our own GPTs. China returns to deflation. Quarterly report, Disney. The liquidity of Berkshire has reached a historic high at $157 billion. If it is true that Warren Buffett refuses to spend money to buy stocks unless there is real intrinsic value, then it can be said that the market is still likely overvalued. This is because Buffett's conglomerate, Berkshire Hathaway, reported an increased liquidity of $10 billion in the last quarter, reaching a record figure of $157.2 billion, divided as follows: $30.8 billion in cash, $126.4 billion in treasury bonds, an increase from the $93 billion at the end of the previous year. Berkshire's liquidity is now set to surpass that of Apple, which is $162 billion. During the quarter, Buffett's conglomerate was a net seller of stocks, liquidating another $5.3 billion in stocks and bringing the total sales in the last 12 months to a record $38.3 billion. In terms of numbers, Berkshire reported that operating income increased by 41% to $10.76 billion. However, it recorded a net loss of $12.8 billion, compared to the loss of $2.8 billion in the previous year. The slowdown is largely due to the decline in Apple stocks, Berkshire's largest holding, representing over 50% of the portfolio. Apple shares fell by 11.7% during the quarter, although they have since bounced back by over 6%. As usual, Berkshire has urged investors to look beyond the quarterly fluctuations in the stock portfolio and focus on the long term. While on one hand, the interest rates have allowed Berkshire's liquidity to yield, on the other hand, they have also created some issues for some of the industrial activities in the portfolio. For example, companies related to the construction sector in the conglomerate have seen an 11% decrease in revenue. The effects of significant increases in U.S. mortgage interest rates over the past year have slowed the demand for home building and other building products activities, Berkshire stated in a report detailing the results. We continue to anticipate that some of our businesses will experience weakened demand and declining revenues and earnings in 2024. The shares closed the week down by -0.4%. U.S. versus EU profits. Opposite situations in the United States, the downturn in profits seems to be coming to an end, with recent estimates from FactSet projecting positive growth for the current and upcoming quarters after 3 consecutive quarters of decline. However, the situation in Europe is different, with third-quarter profit announcements showing the first year-on-year decline since 2020. Even excluding energy and materials, strongly affected by commodity price volatility, European companies are faring worse than their global counterparts, as seen in the chart below. One major contributing factor to the slowdown is that European companies have struggled to increase their margins in the third quarter, unlike their counterparts in the United States, Japan, or emerging markets. This reflects challenges in passing price increases on to end consumers. In terms of stock prices, there is also a divergence. Year to date, the S&P 500 has gained 13.05%, compared to the Stoxx Europe 600's 4.10%. Now, let's shift our focus to some recent developments in the AI world. OpenAI's ChatGPT achieves milestone and introduces customization. OpenAI announced that ChatGPT now has 100 million weekly active users and introduced a new AI model, GPT-4 Turbo, capable of analyzing over 300 pages of text in a single prompt. Moreover, over 90% of Fortune 500 companies are building tools on OpenAI's platform. In a significant move, users can now create custom versions of ChatGPT for specific personal and professional tasks using natural language, without writing any code. These customized versions, called GPTs, can quickly assist with tasks like teaching math or explaining game rules. Users can enhance responses by adding datasets and documents that the custom chatbot draws upon when generating answers. OpenAI also announced the upcoming launch of the GPT Store in December, allowing users to share their personalized chatbots with the public. In summary, these developments showcase the rapid advancements in AI technology. China returns to deflation in October. China's consumer price index fell by 0.2% year-on-year, contrary to analysts' expectations of a 0.1% decline. China's economy has shown mixed signals of recovery in recent months, raising debates about whether it can achieve its official GDP growth target of 5% this year, the lowest in decades. The IMF revised upward its GDP growth forecast for China to 5.4%, citing increased policy support, including eased monetary policies and relaxed restrictions on real estate purchases and mortgages. This aims to stabilize the real estate market, a significant concern for the country. Apartments represent a substantial portion of Chinese families' wealth, and declining property prices have made people hesitant to spend money. While recent inflation data may make markets cautious about China's growth recovery, it also fuels hopes for additional policy support. The CSI 300 index closed the third consecutive week in gains, while the Hang Seng index lost ground. Disney beats earnings and increases cost cuts a year after Bob Iger returned to lead Disney. Significant changes have occurred, including a substantial cost-cutting initiative expected to save a total of $7.5 billion, $2 billion more than initially stated. In the last 3 months, Disney, the world's largest entertainment company, reported earnings of $264 million, or 14 cents per share, compared to a net profit of $162 million or 9 cents per share a year ago. Excluding impairments, the company reported an EPS of 82 cents, surpassing expectations of 69 cents. Revenues grew by 5.4% to $21.2 billion, slightly below estimates of $21.4 billion. The Park and Experience division, including consumer products, saw a 12% revenue increase to $8.16 billion, driven by a 55% international growth. Streaming sector losses, including ESPN+, reduced to $387 million, beating Wall Street expectations. Disney aims to achieve profitability in this sector by the fourth quarter of the new fiscal year. Globally, Disney Plus paid subscribers rose to 150.2 million, exceeding estimates of 147.4 million. Core Disney Plus subscribers grew by 7%, reaching 112.6 million. Besides cost reduction, Iger is evaluating how to reposition Disney's traditional TV networks, including ABC, National Geographic, and FX, which continue to lose viewers and advertisers. Iger expressed willingness to sell these operations or explore minority investment or joint ventures to accelerate ESPN's transition to streaming. The stock ended the week up by 3.8%,